think a bear market can happen, especially in real terms, right? So obviously, if markets go flat for a decade, but inflation averages 6% for the decade, that's really poor performance in real terms, even though we don't think of it as like a big market crash, for
Correct.
example. And so I kind of look towards that possibility as being somewhat likely. And there's a couple catalysts to look for, I would say. So one is, basically, if interest rates were to rise, that would be very detrimental to the equity market. I mean, if Treasury rates go up to 3, 4, 5%, right? That'd be devastating for some of these, especially these really high valued growth stocks that are like unprofitable growth stocks that we're happy to pay 10 or 15 or more times earnings for, and times revenue for, because basically interest rates are so low, alternatives are so low, we're betting on their future out 10 years. If those discount rates go up dramatically, that puts a lot of pressure on those big companies, and then also including some of the big FANG companies that really kind of drive a lot of the S&P 500. So that would be a risk. Now, if interest rates stay low and inflation stays hot, that's a trickier outcome. The catalyst I would look for there would be if the Fed basically stops doing QE, because QE is a complicated thing because the inflation we're seeing is largely due to fiscal spending and other measures, which QE supports. But QE on its own is not necessarily inflationary, as we saw from the 2010s decade where they did QE, but it just stayed in the banking system because there was no fiscal spending to really get that out into the economy, and so instead it just inflated asset prices. And so I would say that if you get into an environment that's rather inflationary, and it becomes somewhat self-sustaining with wages going up and therefore prices going up, and then therefore wages going up and therefore prices going up, if that becomes a more self-sustaining loop. And if they slow down QE or end QE, that could be a rougher time for equity markets, because you have less of that asset price inflation most likely, and you still have this underlying real inflation going on.
When you think about somebody like Jack Dorsey and Square, obviously they have a very incredible data set. One of the things I'm fascinated by is not only is it a data set of point of sale data, but also they have everything from the payroll data for companies that they work with. They also have the consumer cash app. They have cards. They kind of have, in my eyes, kind of a 360 view of many data points, both in real time, lots of them, and across a diverse set of market participants. And so I continue to say that is, in my opinion, one of the most valuable data sets in evaluating some of this. Do you have any thoughts about what the data would show if somebody could actually see that versus like the government's ability to collect some of this data and analyze and use like cost of living index baskets and things like that? Like, how do you think about the data we're looking at? And I use that as a proxy for if we have bad data, then we're going to make bad decisions regardless. But what are your thoughts on that?
I think they could certainly construct probably a more accurate or real-time inflation measure in the company. I don't know if they have one, but I think they could with their data. And it's also clear from Jack's tweets he's been looking at macro stuff. So he's like looking at probably like the WTF happened in 1971 site. He's been mentioning alternative ways to measure inflation. Obviously he had that famous hyperinflation tweet. He's been looking at obviously some of those macro things. And so I don't know exactly what he has in terms of internal data, but if they wanted to construct an internal inflation measure, they could. And an example I use, like, so if you go back to that rent inflation and owner's equivalent rent inflation, so house pricing used to be included in the inflation basket. If you back in like the early 80s and before then, and so if houses go up 20%, that would be in the CPI. Now they took that out because they said, okay, well, houses are a capital asset. We're trying to measure consumer price increases, but we still obviously housing is a big consumer expense. So they said, okay, we'll come up with a measure that determines basically what is the equivalent kind of monthly expense of being a homeowner. And so they kind of put that wonky measurement in there. And if you track home price growth compared to owner's equivalent rent growth, there's a couple things. One is that housing prices grow faster than owner's equivalent rent. So it's basically a way to understate inflation in some ways. And two, it's a lot smoother. So it doesn't go up and down as quickly as housing prices do in some of these big events. And yet, so if you look at, say, the largest owner of single family homes in the US is Invitation Homes. It's publicly traded. I believe it's a REIT structure, but it's publicly traded. And so they own like tens of thousands of single family homes, and they disclose their rent increases. And offhand, the numbers were something like 16% for new tenants and something like 7% for renewals, and the average was like 11% across their board for rent increases. Whereas if you look at rent and CPI, it's nowhere near that. And so it's kind of coming in with a lag, and it's somewhat understating it. So if Jack's looking at, or if people at Square are looking at kind of, real-time data, they'd probably see, closer to the real numbers for some of the inflation we're seeing, rather than seeing this kind of laggy managed basket that slowly catches up over time, but still understates it.
And then one of the other things that I'm really, really interested in is as people see the higher and higher inflation number, it feels like people are getting red pilled on a daily basis. And they may not even know what inflation is. So some see CPI, some just see, I went to the store while we were on the show, somebody DM'd me a screenshot of their Chick-fil-A order and it's like $14, right? And, of course, there's sticker shock with some purchases. How do you look at changing the portfolio? Right? Are there things that you're tactically doing as inflation continues to not only be persistent, but actually accelerate in official numbers? Or is it, no, I positioned myself kind of Q3, Q4 last year for inflation, and now it's just playing into exactly how I've been allocated in a portfolio perspective?
So I've not been making many changes lately because I've been positioned for this. I made a lot more changes last year or earlier this year where I was kind of positioning for things. Whereas now I've actually been in a state of not making very many changes at all because it's just kind of playing out. But you raised an important point there of basically, we talked before about differences between now and the 1940s. And one of the differences is the speed of information. And so in the 1940s, you didn't have the internet. You got like a newspaper. Many people weren't even following the markets, obviously. And so you couldn't sit there and look up, say, St. Louis Fed website to get the exact, what is inflation right now according to the government. You couldn't do things like that. And so when they held bonds that were yielding 0 to 2.5% for a decade while inflation was averaging 6%, there were obviously financial professionals that were aware of that and could somewhat quantify that. But it's not like people on aggregate could tell you those numbers. Whereas now with the internet, with Twitter, with social media, and memes that can spread information very quickly, people like just regular people know what they can look up inflation, they can look up bond yields, they can look up their whatever wage increase they got over the past year, and they can say, wait a second, I'm getting paid less than my pay went up 5%, but inflation went up 6.2%, and that inflation rate might even be understated. So that's not good. Or they can look at, they can post their pictures of what their Thanksgiving turkey cost this year compared to last year, and then it'll get 10,000 likes and go viral. And so that's a very different dynamic than you had in the 1940s. And so that can make it difficult to, that topic is called financial repression, which is where you hold rates below the inflation rate for a prevailing period of time. And sometimes it's combined with regulations that force certain pools of capital to own those crappy assets, like banks or insurance companies or pensions or other large pools of capital. And financial repression is easier when information moves slower, where it's a lot harder to do when it moves at the speed of light.
Before we continue, help us clicking that YouTube like button and subscribe now to our channel. This shows the algorithm that you valued this information. And it helps us spread that message. Sharing is caring. And now, let's continue.
Do you want to know one thing about crypto? I made over 3,000% in profit in a few weeks. Fact is, the traditional financial system, the traditional money system makes you poor, not rich. If you want to earn $500,000, $1 million, you have to wait until you're 50, 60, 70 in the traditional financial system, and you probably will still be broke. And you will be old. This is not a sexy combination, as you can imagine. But the question is, how can you start in crypto and make these profits? Where to invest? Where to start? My name is Gunnar and I'm from Germany, as you can hear, and things are a little bit different in Germany. More about that later on. Fact is, there are lots of different cryptocurrencies. It's a gigantic universe where beginners and professionals get easily lost. But there is light at the end of the tunnel. There are 7 key steps you need to follow to become successful in this market. You have to know them, and if you fail one of them, it's literally impossible to succeed in this market. Just an example, one of the key points is your exchange, and one of the biggest are, for example, Binance and Coinbase. These are trusted and well-established exchanges, but, and this is a big but, You won't find the super profitable coins on those exchanges. The unknown super profitable coins that get gigantic profits are not traded on those kind of exchanges. They are traded on much smaller insider platforms that are barely known. And I can tell you what those super secret exchanges are and why they are so profitable. And another super important thing are the right information sources. The point is, the internet is gigantic. There are hundreds and hundreds of YouTube channels, blogs, pages, and much more. And there are also market makers and influencers. For example, Elon Musk, he is not a crypto guy, but the moment he recommended Dogecoin, it went through the roof, to the moon, so to say. But why did he recommend it? Where did he hear it from? He didn't hear it from newspapers. And believe me, he is listening to someone. But you have to know who, and you have to react before he is reacting. This is really important. And these are only 2 of the 7 steps you have to follow in order to be successful in crypto. And if you want to know all of these steps in much more detail, and if you want to have a comprehensive checklist, here's what you should do. There is a link below this video. Click on this link and you will get the opportunity to subscribe to my channel. Click on the link and you will see a video where I explain the next steps. So see you soon. Click on the link now. I'll see you there.